In this presentation, we will work a problem related to a capital lease, which we will post to a capital projects fund and the government-wide activities. The information is going to be on the left side. We're going to put that into the blue area on the right side. We're going to journalize the journal entries into the general journal, then post them to our worksheet so that we have something that's in balance. We have a beginning balance, the activity, and then the ending balance so we can see how these funds will behave, how they will act. We'll have the assets in green, liabilities in orange, and then we've got what would be the equity accounts, the assets minus liabilities, fund balance in this case, in the light blue, and what would be the income statement accounts, temporary accounts, those that would close out to the equity account if it was a for-profit type of organization, in the dark blue. So if we scroll back over, our information is going to be that we have a capital lease. This is going to be a capital lease for a construction project where we're going to hire a contractor in order to build a building, and then we're going to use that building in the form of a lease. So in essence, we have a capital lease set up in that we got the construction process of the building, and then once the building is constructed, it will be leased for a long period of time, and therefore we're going to put it on the books as a capital lease. Now, how would we do that with regards to the capital projects fund and the government-wide activity? The capital projects fund wants to track the activity related to this building, and then the government-wide activities is going to record it more on an accrual basis in more of the fashion that we would expect, because it will be used in the standard accrual basis. So the information we have up top is we got the fair market value of the building is the 19 million. The payment is going to be this amount, and then we're going to make some more payments, and then we have the interest rate. So we're going to be making payments for the 30 years. We want to record this on the books. Note, we are in essence going to put this on the books not as an operating lease, but as a capital lease. So we're going to put the actual asset on the books. In this case, that being a building. So we're going to say that we're not going to expense the payment. We're going to put the asset on the books. And so we'll debit the building. And then the credit is going to go to the payment that we did make. We made a payment of cash. So we're going to credit the cash payment. And then the difference is going to go to a lease obligation, a liability, similar to if we had purchased and financed the building. So the difference is going to go to the lease obligation. We're going to put the building on the books for the fair market value of it. So we're going to say the building's going to go on the books for the fair market value. So we'll scroll back up top and say that's going to be for the 19. And then the payment that we're going to make is going to be negative. I'm going to credit that because the cash is going to be going down for the payment. The difference then is going to go to the payable. So the lease obligation payable then is the negative sum. I'm going to call this the plug formula, the difference, the debits minus the credits. And then if we look at the credits, then we have the credits now equaling the debits. We can go ahead and post this out. This is what it would look like. We're going to say that the building first. Here's the building account in our journal entry. We're going to post that to cell K17 equals, scrolling back over, picking up the debit and enter. So there we have that item. Next, we're going to have the cash. So cash is going to be down here. It's in cell K16 equals, and then we'll point to the cash. And so cash is going to be that item. So cash goes down. And then finally, we have the lease obligation, the payable. So the payable is going to be in cell K19 equals, and we'll pick up the item in K19. There we have it. So this is going to be the capital lease. We're going to put it on the books. We're not going to expense it. As we would with an operating lease, we'll put the building on the books, and then in essence having the financing for it would be similar to purchasing the building as we would expect from a capital lease. What about the capital projects fund? Capital projects funds, we want to track this because this actual lease is going to be also with the construction of the building that we are leasing. So within the capital projects fund, we're going to record the flows. So we're not going to then have the long-term asset being the building on the books, but instead we're going to be recording the flows. So the way we're going to do that is first we had the building last time. We're not going to record the building. We're going to record an expenditure related to it. So we're going to scroll down and say that we have the expenditure. Remember, this is fund accounting. This is going to be more of a short-term type of flow type of accounting. So we're going to pick up the expenditure, and that's going to be equal to the 19. And then we have the cash. Cash is cash, so we'll do the same thing with cash. It's going to go down by the payment. And then the difference is also, we had before a liability, long-term liability. We don't have a long-term liability on the fund accounting modified accrual based on short-term activity. Therefore, we're going to be picking up another type of income statement kind of account, a flow type of account, temporary type of account, other financing sources and uses. And you'll see that this kind of nets out then on the income statement. We're going to say negative sum of these items, and you can see then the expenditure and the other financing sources and uses then kind of netting out on the flow activity within what would be similar to the income statement of the project fund on the modified accrual basis. So let's post this out. We have the expenditures. If we scroll over to the expenditures, we are in cell K8 equals, scrolling back over, we're going to pick up that debit and enter. Then we're in the cash, so we are in K3 equals, and we'll pick up the cash, making that go down. And then we are in the other financing sources and uses. This item, that's going to be in K7 equals, and we'll pick up the credit and enter. So there we have that. And now the cash is doing this similar activity, of course, but we have the difference here where we're going to record it in essence is netting out on what would be the temporary or income statement accounts, whereas down here, of course, we're posting what would be the long-term asset and the long-term liability.